So as we get bombarded here with another snowstorm in the state of Utah, as we get our snowpack levels up, again, past record levels that we've seen before, just continuing to add to that. The market started the week, this holiday week, spring break week for where we're at here, even though, again, you wouldn't notice that if you can see all those white flakes outside. But the market started off with a little bit of a positive note. It was positive. There were some, not so good signs from a volume or breadth standpoint, but right now we'll just take what we can get. If we can keep marching higher, however we do it, we'll do it. We would take that. It is spring break, which means as a family, I'll be gone. So today is my last video for the week. I won't be back until next Tuesday. I do get back late Monday night, so if the markets do, for some odd reason, tank, as they have been prone to do in the past while I've been on vacations, then I'll probably do something Monday night. But if we can continue to march higher with low volume and low ranges, then there won't be a whole lot to talk about, and we'll be just fine. It'll be a good vacation all across the board. So that's the next time I'll be on video. I'm gonna break down I did a pretty long video over the weekend, so if you didn't see Friday's video, check that out. I kind of showed all the red flags that are out there that don't necessarily support this move. I kind of reiterate some of those signs today in today's video. And there was obviously one big move in the commodity sector today and had its impact. So we'll break that down in terms of how that impacts what we talked about over the weekend. And then our trade idea is a trade that the stock really broke out on its own into a really good bullish pattern itself. So we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, April the 3rd, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you down there. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our website here, check out some of these other things over here on the right. You can see we updated we got a new calendar, new month worth of trading rooms that you can register for. Some other things that Brandon's posted on here as well. Come down here to the bottom, click on this heart. It takes us to that tab eventually. And you can be able to click on that like button right there. Also, same thing, click on that thumbs up icon. It takes you to this tab, hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. Really important for us. That's why we always ask for it. We took a big drop. We have been multiple videos, at least for me, above 100. In fact, our last video was like above 125, and then we dropped 40 likes. So I don't know if that means the video wasn't very good, or if it just wasn't part of your normal routine. So again, for those who do that day in and day out, thank you very much for clicking those likes. For those who don't, or if you missed on Friday, you can click right there, or 1 and 2 really easy clicks. And like I said, really important for us and helps us out a lot, and helps get our content out to people on those platforms that follow us, as well as other people based off the shares and the retweets and everything else, and the likes and the comments, based on how these algorithms work. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the nice good rally that we've had here. This is now, fourth day in a row, and 7 out of the past 8 days that we've had to the upside. One day there, 1 day there. So it's been very sporadic, the down days, and good, strong little rally. And that breakout that we had on Friday so far, today's move holding it, that's a really, really good sign. Sorry, I had to get the frog out of my throat there. The intermediate line is way up there, and now it's practically going to get into above the 80th percentile. It's just a matter of probably tomorrow, unless we have an extremely down day tomorrow, which obviously is unlikely. But you're probably going to get the intermediate line crossing above 80 tomorrow. So we went from 74 today. Yesterday we were at 63. So pretty darn likely. The near-term line, is well in the upper reversal zone. 97th percentile. Very, very strong move. Again, without the momentum line getting there, so that's a bit of a risk factor. The momentum line still is in neutral territory because we're just not getting very big ranges. Like today's range was less than half the average, and the average is coming down. So that's a really, really small range. I mean, it's less than 1%. 1% is 41 points, and we had a 28 points. So very, very small move. But again, as long as it's a small move to the upside, good, right? Dark green shading, green line. The market sentiment line is now rising again. It's been kind of pretty much up or down right around the 60th line for the past few months. But again, over 3.5% above the moving average. That's a good level as well. All signs are go here on the S&P 500. The Dow Jones Industrial Average really breaking out today, now 3% above. So it had a really strong move, stronger than last couple of days, really breaking strongly above, solidifying that bear tag that we got a little bit later than the others. And then again, near-term line up there. The momentum line again, very weak, because again, a lot of this strength has been late. But in the intermediate lines, relatively market sentiment still in bearish territory, so there's still some catching up to do. But remember, it was one of the more bearish indexes. It actually got oversold clusters, and now it's rebounding and catching up. Your NASDAQ, of course, has been the most bullish and really broke out Friday, and now again, very small range today, very small move. And you can see we're down just a little bit. So again, it was so overbought. Not surprising that it's going to slow down at least a little. And then your Russell 2000 is actually still below its moving average, and it was down today. So that puts a little bit of a damper on things because, again, this is kind of more representative of the broader economy market as a whole, whereas the Dow can be, depending upon what's moving inside the Dow, can really move that price-weighted average. And then, of course, we all know the NASDAQ's been the big winner, a really small element inside the NASDAQ. And so we kind of want that small element to be broader and to get a lot of movement much more broadly. And the fact that the Russell still can't get above its moving average and get a bear tag is a little bit of a weak sign there. Throwing a little bit of cold water on this move that we're getting, this nice move. You're back to a golden cross. The 10-week has crossed above the 40-week. Very strong bullish candle. Again, we didn't close above the highs on this reversal candle. And we're not doing that here yet either, but we're pretty close. Really, really close. In fact, we might be just a little bit above it, 410. 413. We're a few points above that high point. So we're actually pretty close to having a good close. See, this is the first reversal out of all of these bullish moves in the past year. This is the first reversal where we didn't close above the transition candle. This being a transition candle, we didn't close above the high of that transition candle, whereas all the others were easily above the high of the transition candle, every single one of these. Even this one that had a pretty big range in the transition candle, you had a high that closed above that. So didn't get that last week, which is a little bit of a red flag. But at least this week so far, only one day into it, and 1 day into a 4-day week. So we only got 3 more days left of trading this week. But so far, so good from that perspective. Looking at the 3 green arrows, we have 3 green arrows in all the indexes except for, of course, the Russell 2000, which still only has 2 green arrows. And the S&P and the Dow are newly green, but at least 3-4 days. NASDAQ, of course, has been a lot longer than that. You're looking at the S&P 500 here. The 8 and 17 day are crossed above the 30, so very good sign from that perspective. They're both above the point of control. We're back at that narrative changing level that when we were at February, getting above these 2 lines changes some significant narratives. The 78% line changes the impulse move from being down to up, and then the 50% line of this correction is that line that up until this past year, we had never gotten above without, and we had never produced new lows after getting above. Of course, in August, we threw that 100% odd signal away. Now it's a 99% odd signal. So still pretty decent odds that we get above these 2 lines and the point of, the value area for that matter, pretty decent odds that we can really just kind of take off. And you can see the 23% lines looming too of the post-COVID rally. So again, another dotted line, which is another narrative changing line. You get below it, you're in pullback mode, and you get above it, and you're not pulling back anymore. So some really important levels there from that perspective. On the S&P, the Qs are trying to hold the breakout above very similar important Fibonacci levels for it. IWM is trying, I mean, it's nowhere near those levels, but it's at least trying, so because that's way up here for the Russell 2000. It's just trying to get above resistance, right? You're between the 30 and the 17-day moving averages, and for that matter, the 200. So you're not, and you're easily inside the value area, so you're not really breaking out there. So we kind of need to see that breakout if we want to see, everything else kind of go along with the NASDAQ, right? We need to kind of see this go along with it. Let's take a look at some of the other oscillators. You're above 30, you're almost below 20, so you've got a rising ADX finally on SPY, of course. IWM, that's not the case, but at least, we're close to that being the case, and the Qs have just been so parabolic already. Remember, when you cut that in half, they're really parabolic there. The S&P 500 looks like it's kind of solidifying and moving to bullish territory there. Of course, that's not the case for the Russell 2000, but it's close for the Russell 2000. Looking at the Ichimoku cloud, we finally have a weak trend going on the S&P. As crazy as that is to say, we have a weak trend developing on the S&P. You're above 1, just barely. You're above 50, just barely. That's what it takes to get a weak trend going. The Qs have are close to an intermediate trend strength going, which is also weird to say, considering how bullish it is. But you're just barely getting, you're not above 2 yet. You're not above 65 yet. Of course, your IWM is actually still on a pretty strong bearish trend. Even though you got strong negative rate of change, you're below the blue line, well below the cloud. So again, another reason why it's just kind of very, very significant divergence there. It's not a good sign for the broader markets. We are close to that 100% line. We are close to getting outside the Keltner channels, which we're not there yet. See, we weren't outside the Keltner channel on this move and ultimately faked out there. We saw this before in March, so last year as well. The bands are close to breaking outside the Keltner channel, though until price gets outside the Keltner channel, and for that matter, ideally outside the Bollinger Band, it really doesn't really make a lot of difference. So that's a little bit of an issue. IWM is not in the upper quartile. It's barely in the upper half of a declining bandwidth, and the bands are now inside of the Keltner channel. So we're actually kind of not trending now. We're going into a basing pattern on the Russell 2000. The NASDAQ, of course, has been significantly bullish and potentially, because again, we saw this back here, when you're in a bullish trend, but you're not above the Keltner channel, and then you finally do get above it and kind of a blow-off top type move, then you can kind of see we might be in a blow-off top type pattern right now on the NASDAQ. Again, considering how bullish it was, how strong that momentum is here. You wonder, is that break above the Keltner channel for the first time, enough to keep us going there? See, we got outside the band over here. We got outside the band right there on that day, but that was not enough to get outside the Keltner channel. And so we ended up staying inside the Keltner channel that entire time. And, again, it's kind of hard to really get a trend going and keep it going. And when that's the pattern, you ideally like to get outside of both the bands and the Keltner channel, ideally, or at least get outside the Keltner channel soon as the bandwidth exceeds the Keltners, and that's just not the case either. So you see the red flags are still there. You have a very strong pattern here. Of course, you got the Arun indicator showing the breakout pattern there. You got a new high again today, so you're still at 100. This is well below 30, so it's getting close to dropping to 0. So kind of keep that in mind. That's the SPY. IWM, of course, that's not the case. But you are set up for a move to break out here You can see the high is going to be gradually moving lower and lower, and IWM is at the top of this range. So we are pretty close to IWM producing a breakout pattern, which would be really good for it to start catching up to some of this move. Looking at some of the other breadth indicators, the McClellan oscillator, again, did not get above 100, so we're kind of failing with that breadth thrust there. The other thing, the new highs and new lows are really, really low. Let's see, let's go to the new highs and new lows. This hasn't been completely updated, but as of right now, it's at 24. Again, that's a very, very low number. For how bullish we are, that's a very, very low number. Of course, in August, we were well above, right? So in January, we were well above those levels. In August, we actually got above these levels. So and you can see how, since we didn't get very far above it, it ended up being more of a fake out pattern. And again, it appears that something like that's developing now. You're at the 50% mark, 52%, 53, excuse me, of stocks that are above their 50-day moving average. The average stock is sitting right at the moving average, so you're at 0% there, a little tiny smidgen below. And then the number of stocks that are more than 5% below the moving average is broken down below 20. So breadth is improving. It's not strongly bullish, as you can see on some of these other indicators. For an example, let's see here. Let's go to the number of stocks above the 50-day moving average. You can see that when you get above the mean here, and especially get above that 60% mark, that's when the trend really takes off and develops. And you can see we did that back over here on back in the end of July, kind of really close to the end of July. We crossed above the median part, so we crossed above it really early in the trend. Back over here at the end of July. We're a little bit late here on this one. So again, we've been struggling with breadth. It's starting to show some improvement, but it's just not quite. Again, not above 100, especially kind of again, we like to see you get, especially when we are below 100, you would like to see that follow up with a move above 100. Money flow is also not as supportive as you're already dropping back down, and again, you look at for example, over here in September, we were actually at the exact same level, 410.97 or at 410.95, and you look at where the money flow was then compared to now. If you follow my cursor to the right, and we're just nowhere near, right? Nowhere near those levels. You were somewhat close in this area. So on this day here, you closed at 410.80. We're at 410.95 right now. So you are pretty close to getting back. But again, you're not there, and we're a little bit above that now. And the fact that we're not back to those levels is just a sign that we're just not getting the money flow, the breadth, the volume. It's still very niche. This is a niche area of the market that's rallying. And today, energy kind of joined that, but that's not the kind of move that really supports a strong trend to the upside. VIX is really low at 18.5, though it's not very low on a relative basis. The VVIX has also dropped really, really low. We've talked about the rapid decline in both. It's not uncommon for the VIX to decline. It's uncommon for it to decline this far, this fast. This is one of the faster moves to the downside for the VIX over the last little bit, and so it makes it, when you get the sharp declines in the VIX, it typically sets up for a V-type bottom rather than the slow, gradual decline that you generally get over, say, like an exploration cycle. For example, over here, as an example, we closed up here about 26, and we've been gradually moving lower over the matter of a couple of weeks post-expiration, 25. Well, if you look over here, when we were at 25, it took us a while to move. Let's see, down into this area. We were right around 26, 25 there. It took an exploration cycle, and we never did get down this low. But you get the idea that this is a much faster decline than what we've seen on any of these other declines. That we've seen that happen before. We saw kind of a rapid decline right here in early March, late February, early March, and it led to a pretty decent bounce. And we'll see if that ends up being the case again. All right, now let's take a look at what's driving a lot of this price action. Again, you can see the 3-month returns on the Qs are just outstanding, and everything else trying to catch up to where they're trying to lead the markets higher. But today was just such a kind of a weird day with that jump in energy prices. It's had its impact. Of course, commodities, not surprising, being the best performer. Big percentage of that is crude oil. Developed markets also doing well. It's a little surprising that emerging markets didn't do better than they did. The weakness in the dollar just dropped off pretty sharply. That's a pretty big move. I know it doesn't look very big, but for UUP, that's a pretty big move. It's relative to its average range. Long-term bonds were higher. It means yields were down just a little bit there. Real estate was down. High yield was down. The Qs were down. So, what has been working and some of the risk-on moves kind of pulling off. And the S&P doing well because of the strength in that part of the risk appetite scale. Let's take a look at DVC. Some of these different asset classes. Look at DVC first. Big break above the 50-day moving average. It had already broken above the 30, so now getting above the 50 is a significant deal. On a weekly chart, you are back above now the 17-week. We closed above the 8-week last time. Now we're above the 17-week moving average. MACD is above its moving average. Stochastics is moving higher, above its moving average. So, we're getting a little bit of a move to the upside in commodities and weakness in the dollar. You can see the dollar's dropping. Remember, we talked about this during 2022, that as strong as inflation was, the dollar was so strong that it really helped inflation be not nearly as high as it could have been, especially from a commodity standpoint. Well, now the problem is your dollar's dropping pretty hard, and commodities are rising again. So it's going to, again, be pretty darn hard for that year-over-year CPI level to stay down, even just to get down to 2%, much less stay there, if commodity prices are already, especially if the dollar weakens significantly, and that pushes commodities higher. I mean, you can see during this part right here when the dollar really dropped from the COVID highs all the way down to early 2021, when inflation really started to take off, commodity prices really took off. Went from 10 all the way up to about 17, about a 70% gain by the time we got to that point. So a big drop in. So you can see commodities continued higher with the dollar rising too. Again, you just wonder how much higher this would have been if the dollar hadn't also been rising as much as it did. Look at TLT, and you can see again, it was an update today, and like we talked about on Friday, TLT is kind of at a kind of a flipping point here. If it were to break up above, say 110, or at least get above this 108 level, get above these highs, get above the 200-day moving average, get above this 23% retracement level, get above the point of control, and really change the trend, which would also be the 50-week moving average. If it were to able to get above that, and again, rising bonds is not necessarily a sign of broad risk appetite right now, especially with the yield curve inversions as much as they are. The 10-year yield is on the verge of breaking down. Below that, there's a pretty wide gap between the 50 to 200 week moving averages. It might be one of the wider ones that we've seen. Let's see here. I'm going to venture to guess it is, but we can confirm that by this changing this. Yeah, about 80%, by far one of the bigger gaps between the 50 and 200 week moving average. And you can see when you get below the 50 week moving average, you make a run towards the 200 week. That's what happens. Now, for the most part, the 10-year yield has been below the 200 week moving average since the 2000 bear market started. A little bit of a move higher in 06 and 07, but from then on, it's been a deflationary environment, and obviously now we're in an inflationary environment with this move higher. But if the 10-year breaks 3.4%, your yield curve inversions, which are already pretty historically low, especially the 10-year to 3-month, which is down to 1.37% there. You can see it here on this chart, 1.36, 1.37. That's a low level. The 10-year is dropping, as you saw. It's down to 3.4%. The 3-month is not dropping. It's at 4.77. It's actually more than likely going to rise, because you'll notice the odds of a rate hike for this May cycle is above 50%. It's at 56%. It has been at 100% already. So it's not like this would be a big change in sentiment to get back to 100. And you can see kind of going forward from here by even in June it's at 56%. So there's the market's pricing in a rate hike in one of these meetings, and then for that matter to be done, because you notice once you get to July, you have a 31% chance of being at 5.25% and a 70% chance that you'll be cutting from 5. If we get to 5.25, you'd be cutting back to 5. And so and again, that's the last thing we want to see is rate cuts, because that means the market is just breaking down. The 10 years breaking down below 3.4%. If this breaks down below these lows, below 3.4%, that's not going to be. I know that the macro narrative is, oh well, falling yields is going to really push stocks higher. No, that's not going to be the case, right? If commodity prices are rising and oil is high and commodity prices are rising again and the yields are falling, I mean, that is like recessionary as you could possibly be. And at that point, the Fed would be cutting rates and the market would be in bear market mode. So what we really, really need to see is a 10-year yield to start rising again. These rate cut odds to start falling again, to get one more rate hike in May or June, most likely in May, and then no rate cuts, right? That would get us to 4,800 by the end of the year. Commodity prices would stabilize. The yield, the dollar bonds, wouldn't really break hard because the yields would kind of hold this low point at 3.4%. The dollar would start to rally back up a little bit. That's the ideal scenario. If commodities take off and yields break hard, and bonds really break through that pattern, then that's going to mean rate cuts, and that's going to mean bear market. I mean, there's no way, especially with NASDAQ up 20%. In our class portfolio, we've been hedged against the Dow because the Dow's had the worst margin of safety. You could argue now that the NASDAQ has the worst margin of safety out of all of these indexes because it's so high. Like I said, it's up here at that, all this confluence of averages, and the Dow was too, right? The Dow really took off here and had been so high, but now the NASDAQ has kind of caught up to it, and it makes you think a little bit about, maybe the NASDAQ might be the one that would have the biggest decline to the downside if sentiment changed, because of how dramatic its outperformance was here in the first quarter. Let's take a look now at the sector rotation. So give me 1 second to pull that up. Again, you can see the Qs right there. Those 3 sectors pretty much make up the Qs. But not today, right? Today it was energy. Energy by far, like huge outlier to the upside, up 4.5%. Healthcare also rallying more than 1%. Materials and staples. I mean, this is a combination of weak dollar-sensitive areas as well as safe haven areas. Your utilities are down, and real estate were down, which is kind of interesting because yields were down, and that usually helps those kind of stocks. But they were down today. But so was technology, so was consumer discretionary. So again, kind of a mixture of risk on and risk off, in both directions. Here's what their charts look like on the 12 grid. You notice that. Again, you got dark green shading the green line pretty much across the board now, except for financials, which is still struggling, and you still got a yellow line on industrials and materials. There's your big break in energy. Real estate still, and utilities not really taking off either. Healthcare is looking a lot better. Staples has really gone parabolic here. I mean, these are some very, very strong moves in such a short amount of time. Again, not in the NASDAQ 100, right, like XLK is. So these kind of areas have been so oversold, are catching back up. But you kind of see a little, and we're finally kind of broadening. We're not quite everywhere dark green shading the green line, but we're definitely broadening out and getting more areas looking like that Here's your 12 grid from an international standpoint, and you can see you're starting to get some more dark green shading and green lines in these areas too. Not necessarily in India or in China, but Japan, Germany, you can see really strong. UK is at least above its moving average, along with Canada down there, and Italy over to the right. France is looking much better, very similar to Germany. So there is, again, even from an international standpoint, it looks like everything might be starting to work our way in our favor. It's never going to look pretty. It's never going to look perfect. The trend reversal from being bearish to being bullish, at least it generally is a well-accepted pattern of a correction bounce. We're not getting that, but you don't always get all the patterns you need to see, and we might be in that scenario right now. We're getting a correction bounce that's not your typical, but if it can keep going and it can pull a lot of these other areas along with it, then we might end up getting that correction bounce and avoiding breaking below that 200-week moving average, which is that's the start of an actual bear market, which we haven't seen since 2008, 2007, 2008. All right, now let's take a look at our trade idea of the day, and it's the stock itself that's kind of broken out, and that's Lockheed Martin. It's been so sideways for so long in a very, very small range, but breaking out 2 times its average range today, more than 2 times. Remember, the market itself was half its normal range. And Lockheed Martin way more than doubling its range. The momentum line breaking out to a higher level than what we've seen in a while. Good probability the near-term line will follow suit now. Intermediate lines rising. Market sentiment already been rising, so there's a good chance that intermediate line will rise back above that level. If you take a look at the long-term chart, the weekly chart for Lockheed Martin, you'll see that you had a little bit of a pullback here. You did get a reversal candle, and you close slightly above the body, but now you for sure, and you're closing right now above the high of that reversal pattern. Both these really transition candles, so a good reversal, and it can only get better if we can close up here or continue to follow up on that move. Obviously, you got 3 green arrows today. It's not a surprise. The volume was above average, the biggest volume we've seen in a while since that pre-options expiration day. So that's a good sign for the stock. You are closing above multiple moving averages today. You are below the 8, 17, and the 30. You close above all of it. Held the 50 for support, bounced above it. You're well above the rising 200. So a big breakout above the point of control, near the top of its range here, near the top of the value area. Like I said, big move, right? That's going to lead to big moves in these oscillators. Well above 200, easily above 60 on the RSI and the CCI. You can see its DMI is very big breakout there with the ADX. It was so low. I mean, we're set up for a breakout move. If you look at the Ichimoku cloud, obviously we don't have a trend yet, but that won't be. You have a positive rate of change now. It won't be long before you do get a trend going there. You are breaking outside the upper Bollinger Band. Still not outside that Keltner channel yet, but the bands are so far inside the Keltner channel that it's going to take a little bit more of a move. But I mean, that's a big breakout of the Bollinger Band with a very, very low bandwidth. And like I said, we are set up for a move, for a breakout type move to occur. So what I decided to do here was to come over to the options chain and to do a long call vertical spread and be a little aggressive. We bought the 25 delta, sold the 20. So this is our range. We get about more like a 2.5 to 1 reward to risk ratio here. Almost a 3 to 1 when you're looking at 1500 to 500. More like a 2.5 to 1. So pretty, but it's still a pretty good. But considering how close we are to the 1 standard deviation range limit here to the upside, that suggests that there's a pretty decent probability of success based on how the options market are pricing in, that we're below a 3 to 1 reward that close to the limit. So usually if it's a lower probability, you'll be rewarded for that lower probability with a higher reward profile. We're getting a lower reward profile, which means a higher probability of success, and we can keep our risk relatively low with where we got it position size currently. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free, like I showed you earlier. Follow us on Twitter and Facebook. Like us, like our content there, including today's Market Outlook posts. Have a great rest of your Monday night, everybody, and a great rest of your week. And we'll see you all next week.